Hi, everyone, and welcome to the sixth edition of the Venture Scanner Roundtable. I'm Nader Ghaffari, your host and CEO of Venture Scanner. At Venture Scanner, we provide analyst coverage of emerging technology sectors. We do this by leveraging our in-house technology and data. The format of the roundtable is simply an around the room where each of our sector analysts provides a bit of insight or news from the last week and opens that up for discussion. And we hope you find this informative, and if you have any feedback on how we can improve this, you can always contact me at any time at nader@venturescanner.com. So with that, let's kick it off with Masami Kato, who covers the Internet of Things sector.
All right, thanks, Nader. So I think in the past couple of weeks, we saw a lot of movements in the semiconductor area around IoT. Lots of news there. So to give you a few examples, a lot of new chips are coming out. One by Adesto Technologies. It's a memory chip that consumes like 1/100th of an energy compared to conventional memory modules. It can also withstand high levels of gamma rays, so it can be used after sterilizing in in a surgery room. Another line of sensors from Spansion. These sensors can harvest their own energy from either the sun, the vibration, or heat. The company claims it can be used for up to 30 years without any charge or battery replacements, which is very exciting. We also saw Atmel, a big semiconductor public company, buy a line of semiconductors for communication modules, Wi-Fi chips, from a company called Newport Media for $140 million. And finally, Intel has a group called IoT Group, which the revenue has reached about $2 billion in 2014. They're enjoying double-digit figure growth. So we're seeing a lot of new generation of IoT-specific chips regenerating the semiconductor industry.
Is this in the semiconductor space for IoT, Masami? Is this an area where you see actually startups competing with the incumbents like Qualcomm and Intel, or is this pretty much, the existing powerhouses are basically going to own that market?
I think it comes from both directions. For the big companies, it's actually a very simple play for them, as Intel says. They're using a lot of existing technology that they played around with in the past year. They're kind of downsizing it, making it more power efficient, and they say it's actually a really viable business because they don't have to develop anything that new. From the startup point, there is space to create these low power consuming chips or designing these new generation chips. But whether they can grow to become a big company or they just get acquired by the bigger boys is unknown. The latter is probably likely from my point of view right now.
Great. Well, let's move on. Let's go over to Devin Christensen. Devin covers the digital health market. Over to you, Devin.
Thanks, Nader. Yeah, today I'd like to talk about health data and privacy. This continues to be a very big discussion point within the digital health space, and there's some regulatory concerns, etc. And today, in fact, an FTC commissioner spoke out against the collection and usage of health data from consumer apps, and additionally is publicly recommending the need for heavier restrictions in the mobile health space. So this is interesting because FTC is not typically involved with health data protection. Normally that rolls up under HIPAA, but overall this potential for increased regulation from the FTC or from HIPAA is a cause for concern from many health app developers. And the FTC is not the only organization thinking about it. So really a new group of digital health startups focused on compliance and privacy is beginning to emerge. And these companies are developing solutions to help make both consumer and enterprise health data HIPAA compliant by way of data encryption and anonymization. And two recent companies in the news that are focused on this are Medable and Privacy Analytics, which which recently raised $3.5 million this week. So, to me, why this is interesting is as we move forward, it'll be very interesting to see how health data privacy is policed and by whom, and additionally, the impact that the above companies that I mentioned, the new category of health data privacy companies as a subset of digital health, how those companies will have an impact on the regulatory process.
Are the Devin, are the rules and regulations the FTC plans to put in place, are they above and beyond the things that are within HIPAA? Meaning, are we just going to have additional, more stringent regulations on the data, or is this sort of, are they more or less saying the same thing? And how are they working together, these two regulatory bodies?
Yeah. So what I was able to gather here is that the FTC is more concerned that health app developers are not being clear with consumers on what the data is being collected and how it's being used, whereas HIPAA is more focused on the privacy of the data and making sure that health data remains anonymous, that sort of thing. So I'm not sure how the organizations are working together, and there is some overlap there. But from what I've gleaned, FTC is more concerned on just there being transparency to the end consumer on the data, the collection and usage of it.
Got it. And just by looking at the digital health scan, you can see so much activity in the mobile space, and so I'm sure all those companies are watching this very closely.
Definitely, it's pins and needles.
Right. All right, let's move on. Let's go over to Nathan Suhu. Nathan covers the retail, online, and offline sector. Over to you, Nathan.
Thanks, Nader. So this week, big piece of interesting news was that Amazon launched their own consumer-facing digital wallet, but there's actually no payment functionality, and what it does enable you to do is save loyalty cards, membership cards, gift cards. And I thought that the reasoning for that was pretty interesting. Instead of saying that, hey, look, we know that you don't need your digital wallet right now to make these payments, but you do need it to reduce clutter, right? So we're going to attack the first part of that problem. And so that's why they've kind of limited this bare bones functionality to it. It does signify that Amazon is going to start, or has historically been, but is now pushing more to get into the physical commerce space. That combined with the Amazon Fire phone, they're really making that push to be in front of the consumer at all times. So I think that's kind of an interesting piece, and I'll likely be writing about that in this week's piece of content. So good stuff.
Nathan, are these? I'm sure that was the functionality very similar to what you see on with Apple's and Google's wallets, yep, where you just essentially store, promotions and coupons and so on.
So yeah, that's exactly it. If you look at Google Wallet, if you look at Apple's Passbook, like Apple's Passbook has the exact same functionality, and same with even Groupon's mobile wallet, right? And if you kind of look at all four of those big players, you'll see that actually that Passbook has a decent support for, decent usage out of it. But I don't know if that's just because, hey, look, it comes pre-installed on every iOS device versus this you actually have to go and download on your Android phone, or if it's actually providing some kind of functionality. But yeah, it is very similar to the other offerings that are out there right now.
Okay, great. Let's move on. We'll go over to Wayne Wong, who is now based in Singapore, the financial capital of the planet, covering the fintech sector. Over to you, Wayne.
Well, not yet. We're hoping to be there, Nader. So one big piece of news last week was Funding Circle raising $65 million to bid up their business P2P lending space. So Funding Circle is originally a UK company, and I think in late 2013 they started expanding to the US by acquiring a company called Endurance Lending Network. So the thing about the US P2P lending market is that right now it is dominated by Lending Club and Prosper, and I believe they own about 98% of the market. And the main reason why they're able to do this because of the tight regulation. For each loan that you issue, it has to be filed as a security. So for business loans specifically, where Funding Circle is operating in, there is only one player, Lending Club, that is doing consumer and business loans. So it's interesting to note that for Funding Circle, one of the investors was Excel Partners, and they invested in Prosper as well. So it's an interesting sign to note that going forward, Prosper is probably going to keep in the consumer lending space, while Funding Circle is going to push business lending and not into consumer lending. But I mean, I think in terms of the U.S. P2P lending space, I think in terms of competition, Funding Circle is it's a good welcome into a space that's essentially a monopoly for business lending.
Wayne, is this consumers lending to businesses or businesses lending to businesses with this model?
So for P2B platforms, it's essentially anyone can sign up for an account and loan to business or the consumer. So essentially anyone can contribute money, and essentially you and I we can just easily create a Lending Club account and immediately start lending out at a minimum of $50 per pop. So essentially anyone can do it.
Right, and the unique thing is they're just squarely focused on the recipient being a business.
Yes, for Funding Circle, the focus is on business loans. Right.
Is it what's the typical loan size for these businesses? Are they mainly small and mom and pop shops, or are we talking growing businesses who typically take their debt from elsewhere would turn to a service like this?
So the thing about the borrowers on the Funding Circle platform is that they are more small business. So Funding Circle is targeting small business, not just startups. And for the typical business that would be able to loan to borrow money on the platform, is expected to have turnovers of between 1 to 2 million. So pretty decent sized companies, that are trying to get decent loans, not your payday sort of loans, but decent long-term business loans from these platforms.
Got it. Thanks, Wayne. And let's go to the last stop, over to Nate Pacer, who covers both connected transportation and Bitcoin. What are you touching on today, Nate?
Today we're going to talk about Bitcoin, and specifically a very small raise by an interesting company called BitFlyer. They raised $1.6 million. It's a company based out of Japan, founded by an ex-Goldman Sachs trader to do Bitcoin exchange work. And yes, there's hundreds, if not multiple hundreds of Bitcoin exchanges. And yes, $1.6 million is a small value. But what's really interesting is that I think this is interesting in the context of the Mt. Gox failure. At the heart of the Mt. Gox failure in Japan, we now see other people coming up to take the bandwidth that still exists there. This is a yen to Bitcoin exchange. They're new, they're compliant, they're secure. So I think this just shows that the continuation of Bitcoin is solid. And even though certain firms might fail, like Mt. Gox, due to whatever reasons, there's lots of opportunity for smart players to be successful.
Oh, very interesting. It seems like the market continues to have interest there, and just because one firm, goes down doesn't mean that the market's appetite changes. Similar to banking, because a bank goes down doesn't mean that the need for banking goes away.
That's right. That's right.
Awesome. Well, this brings our weekly roundtable to a close. Any of you guys watching out there, always remember that we can be of any service for your startup navigation and monitoring needs. If there's anything you need in making sense out of any sector, really, drop us a line. We'd be more than happy to help. Again, it's nader@venturescanner.com. Have a wonderful day, and we'll see you again next week.